Welcome to the IRS Form 990, a closer look to understand your potential grantees. I am Vita Jahedi, Assistant Director of Learning Services here at Philanthropy, New York. I want to make a special welcome for everyone online with webcast. They are going to be watching and listening through the web, and a couple quick reminders for them online. You'll find it easier to read the small print if you have printouts of the slides, which we emailed to you all. Please make sure to mute your computer microphones, because it causes feedback if they're on. You can do this by hovering on the center of your screen while it's on full screen and clicking the red button to mute your microphone. And a recording of the session will be available to anyone who likes it on our website about a week after the program. If you run into any problems, for those online, please email Daisy Martinez at register@philanthropynewyork.org, or you can call her at 212-714-0699, extension 202. I am now happy to introduce our lovely presenter, Candice Meth, who's Senior Manager of Nonprofit Services at EisnerAmper. Thank you, Candice. Over to you.
Great. Thank you. So today we're going to be discussing the Form 990. But I can't advance the slide. Nope. Okay. So we used to do this session covering the entire form during one session. And what we realized is that the form is so long and has so many attachments that it really made sense to break it into two pieces. So today we're going to be discussing the core form, which is about 12 pages in length, and then we're going to be discussing Schedules A and B, which are typically attached to the form. And we're going to be going over the 2011 form, and the reason why we're doing that is because there are organizations that still haven't filed their 2011 form. Junior year-ends have until May to do so. You have some September year-ends, some August year-ends. So the forms that you will typically be seeing, especially because there's also a lag time to when they get posted to GuideStar, are going to be the 2011 forms. So that's what we're going to be covering today. At the end of the session, I'll just give you a quick overview of what's new for 2012 because the instructions and the form have been released. So we'll just cover a couple of highlights for the 2012 form. In the session on April 4th, we'll go through the rest of the schedules. We'll talk about some red flags as well as some common misperceptions. So first, I just want to cover the threshold for filing. When the revised 990 was released, there was a phase-in period. So they set thresholds which would get lower over a period of time because they wanted to give nonprofits a chance to get acclimated to the new form because it is somewhat cumbersome to fill out. Now that the form has been in existence for several years, the thresholds are set. And they are as follows. If you have gross receipts greater than or equal to $200,000 or total assets greater than $500,000, you are completing the full Form 990. If your receipts are less than $200,000 and your assets are less than $500,000, you're allowed to do the 990 EZ, which is a brief form as compared to the full 990. It doesn't have all the governance questions as well as it doesn't have all the attachments. So it's a little bit easier to complete. And then if you're less than $50,000 in gross receipts, you're allowed to do the 990N, which is basically a postcard that you're mailing into the IRS. That sounds very perfunctory, but actually if you don't file that postcard with the IRS, they will come find you. So even though it's just a very brief filing, it's very important that organizations get that in. I want to point out one thing, which is that there has been a lot of noise in the marketplace that the threshold is simply too low for the 990, that smaller nonprofits are forced to fill out this very lengthy form that requires a lot of work, and they feel like the threshold should be raised. The IRS has come back and basically said, we're not necessarily disagreeing, but we don't have the power to change the threshold. That actually needs an act of legislation to change the threshold. So what you may see at some point in the future is this threshold going back up, which means you may see more 990 EZs. If that happens, there's also been discussion that they will change the EZ to include some of the governance questions. So they will make the form a little bit more complete, including the governance questions, and potentially the threshold could go up in the next few years. So the form covers 4 reporting areas. It covers governance, programmatic areas, financial information, and it also asks about tax compliance. The governance issues that it covers, it asks for your formation, state of domicile, number of voting board members, number of independent board members, and we're going to discuss how the IRS defines independence, number of volunteers, board interrelationships, fraud disclosure, documentation of meetings. One thing that when the form first came out was in discussion is the fact that technically the IRS has no jurisdiction to enforce any sort of governance compliance. So they can ask you things like, do you have a conflict of interest policy, or do you have a document retention policy, but they can't do anything about the answer. So if you check no, the IRS, that's it, it's just information. The idea was that by forcing nonprofits to check the box, it almost shames them into adopting the policies that the IRS, as well as the Attorney General and many legislators would think are good governance anyway. So the IRS said, you know what, we realize we don't have any power to enforce this, but we're going to ask the questions anyway, and hopefully it will get you to start enforcing these policies. Other things they ask about are written policies and procedures, who reviews the Form 990 before it goes out, conflicts of interest, whistleblower policy, compensation and review policies. This one gets a lot of press. Reimbursement policies, document retention, audit process and review, and gift acceptance policies. The programmatic areas. This was something actually that the nonprofits were hoping would go into the form, which was a better chance to talk about what it is they do and their major programs, and do that earlier in the form than where it used to be in the old form. So this was actually, I think, a win for the nonprofits because it lets them prominently display their mission. It tracks their programs individually by expenses, grants, and revenues, and it enhances disclosures over international activities. So again, when you look at the first page of the 990, right there it tells you the mission of this organization. And that's probably one of the most important things you want to know when you're trying to decide whether or not this organization is worthy of a grant. Financial information. The form now asks about donor advised funds, conservation easements, tracking, additions, deletions to endowment funds. Parts of the form when it was initially released were grayed out. Basically, they would be phased in because they realized it was a very cumbersome form, so they were going to basically phase in pieces of the form. One of the things that you'll see is ultimately they're trying to track things on a 5-year basis. So as the form has now been out for several years, you're starting to get that prior year information displayed right next to the current year information, so you can start analyzing trends. So this is a good thing in terms of seeing how an organization's endowment has been doing and how they're spending the endowment. You'll have enhanced balance sheet disclosures, enhanced disclosures of non-cash activities. Again, it's talking about volunteers and non-cash donations that the organization may see. Certainly in a down market, an organization probably doesn't receive as many cash donations, but instead they may receive a lot of donated goods. So the form now displays the type of good and the valuation of the good, and it asks you how you're evaluating the particular good. Is it fair market value? Is it, comparable sales? That type of information. The form also asks you simply, have you filed your employment tax filings on time, independent contract filings, donor acknowledgement filings, tax shelters, compliance with state regulations and filing requirements, support schedule, facts and circumstances test, compliance with gaming regulations, reporting over political and lobbying activities, and also foreign filings. If you have, for example, limited partnership investments, those types of investments that trigger a K-1 may now have you start filing foreign filings that you haven't done before. So this is asking you, are you invested in any sort of overseas transaction? If so, have you filed the necessary documentation? Now, one thing I want to point out is some of these things are not due the same time as the 990, right? So the question is, well, am I doing something wrong if I haven't filed it all at the exact same time? And the answer is no. You can always check no to a box and say, I haven't filed this. And then in Schedule O, you can explain that we have every intention of filing, for example, our 990T. It will be filed before its due date of, et cetera. We are just waiting on some additional information. So just because they check no to a box that you expected to see yes doesn't necessarily mean it didn't comply. That just means you really should go to Schedule O and see if there's any sort of explanation as to what happened. So in terms of 2011, one of the things that I want to point out to you, just because it's a great resource, is whenever the new instructions for the 990 are released by the IRS, they literally designate a section within the instructions that say, here's what's new. And so for me, I don't spend time necessarily flipping page by page as I'm just trying to learn about the new form. The first thing I do actually is go to that section and figure out what's changed. For the most part, the form has not changed over the last couple of years. What has changed is clarification has come out. The IRS has come out and said, oh, I'm sorry, you know, we didn't mean to include program-related investments when we said investments, or we didn't mean for you to be disclosing this type of scholarship or whatever it might be. So really, it's enhanced clarification, and they've scoped out certain things that we were unsure of whether or not they wanted to be reported. So that's why it's a really good thing to take a look. So these were some of the things that were listed for 2011 that had changed. For example, the core form, Part 7, compensation of officers. Instructions now clarify that reportable compensation for officers and employees includes compensation reported in the W-2, box 1 or 5, whichever amount is greater. Originally, the instructions said it's box 5. So every single time you would look at Part 7 and you were looking at the base compensation, that should have matched box 5. Now they've come out and said, we're really looking for the highest amount, right? So if box 1 turns out to be higher than box 5, you should take the higher amount. One of the other things they also clarified is within Schedule J, which we'll be talking about in our next session, the compensation Part 1, Line 3 regarding methods of determining compensation for a CEO or executive director may not be checked if used by a related organization. So basically what we're saying here is when you're trying to answer the question as to how you set compensation for your executive director and they ask you what method you're using, if you're taking comparable data from an organization that you're related to, they're saying that you can't check that you use comparable data because that's basically a brother-sister type of relationship or some sort of relationship where they don't think that that's independent information. So just to give you a brief overview of the form itself, the core form is 12 pages, and all 12 pages must be filled out. And then what the IRS did is they created these attachment schedules. So you may or may not see some of these schedules depending on how the organization answered the questions in the core form. So the answers to those questions in the core form lead you to whether or not you have to list these attachments. And the attachments are A through O, and then they skip some letters, and they go to R. And we're going to see in a second why they did that. But again, just because you don't see, let's say, Schedule C in one particular organization doesn't mean that they missed something. They may not have to complete that schedule. So the idea here was to hopefully try to match up the letters to what it was that they were disclosing. So F for foreign, O for other, R for related, so it made sense to go to R. And then some of them don't really match up at all. M for non-cash, can't really explain that. L for interested persons, don't really get that one either. So to the extent that they could try to match it up, G for gaming makes sense, H for hospitals. But those are the attachments, and those are what they represent. So if an organization is a school, they should be filling out Schedule E. If they're not, you won't see Schedule E. Okay. There are some things that can be attached to the Form 990. For example, a name change amendment to the organizational document is a required element to be attached. A list of subordinate organizations included in a group return as required by item H. Letters regarding termination of tax-exempt status, and this would be if you were filling out Schedule N, which is liquidation, termination, dissolution. Articles of a merger or dissolution, resolution, and plans of liquidation or merger, again, Schedule N. And then reasonable cause explanation for a delinquent return. Those are some of the things that can be attached, which means that if you, for example, make a change to your mission statement, it does not say that you actually have to create an attachment for that. So you're defining your mission within the heading on page 1. If you broaden your mission, you're not necessarily required to attach something to the form, but one might think that if your mission is no longer in accordance with what you originally got your exemption under, that might trigger a follow-up question from the IRS. So whereas you're not necessarily required to attach something if you've changed the scope of your mission, it would probably be in your best interest to talk about it in Schedule O and why you still think this falls within your original application for exempt status. So this is the return itself, and we like to call this in the audit world a wonderful lead sheet. What is a lead sheet? A lead sheet is basically a grand summary of everything that we want to see on one page. And that was the idea, is give you a quick snapshot as to what this organization is all about, right? So first, you've got the name of the organization, and you've got the name of the official officer right underneath there. You've got information as to how to contact them. You've got a description of their mission. And then right below that, you have the number of voting board members, independent board members, volunteers. Right on the face of it, it also asks you if you have any unrelated business income. So they're basically making you put it out there to the world on the front page. And then you have a quick summary of your revenue and your expenses, but not just for the current year, for last year also. So really quick, you can do some analytics just based on the first page. Below that, you have your total assets and total liabilities and your total net assets. And then you have the signature, and beneath that, you have the preparer. So pretty much you've got a quick snapshot as to what they're doing for the year and what they did last year. Just taking a look at certain pieces of that first page. Again, we're giving the mission, we're giving the number of volunteers, we're highlighting UBIT, and we're also, there's a line that asks you if you had any professional fundraisers during the year. Again, that's a question that gets asked in state returns. For example, in New York State, if you had a professional fundraiser, that triggers an additional attachment to the state return, to the CHAR 500. So they're very interested in knowing whether or not you've used a professional fundraiser. And again, when we're looking at the revenue, we're looking and segregating contributions versus program services versus investment income. So we're really taking a look at, if you will, what is your operational revenue versus your non-operations. You know, what did you earn, let's say, off of your investments versus off of your actual programs that you ran. And so now we move on to page 2, and here's where, again, you see the mission for the second time. So it's a little redundant in that way. And the other thing that's a little frustrating about the form is that if you start to go off on a tangent, it actually won't print it here. It will say see attachment. So, you know, most organizations, their mission doesn't necessarily fit on 3 lines. So a lot of times you're not going to see the mission here. You'll see some sort of, you know, reference to an attachment in the back of the form. And then we start listing the major programs of the organization. And you see it says code. When the IRS originally put out the form, the thought was that you would put a code for the program activity that you're running. And there was a lot of, you know, yelling in the marketplace, why is this necessary? And, you know, not necessarily every code description fits exactly what it is that we do. So the IRS basically said, use the code box if you want, or don't. We don't care right now. So this code box most of the time is not filled out, okay? Where it will be filled out is you are required to put a code if you have unrelated business income. So we get to the revenue page, and there's a column that says unrelated business income. You must use a code just for that section. And again, there's an online listing of every type of code you might need for whatever you're doing, agricultural activities, investment activities, whatever's triggering the UBIT, there's a code for it. Okay. And then when we're looking at the expenses and revenues, we want to be very careful because if we're talking about a program-related activity, when you've raised money for a program, it's typically because somebody has attended a function that you're offering, let's say, to your members, or they've bought an educational packet that you were selling. You don't necessarily want to put your contribution revenue here because on this page, you've already said that contributions is on one line and program services revenue is on a different line. So on the next page, what you should be showing is the revenue that you thought of under the umbrella of program services, not necessarily your contribution. Okay? So program service accomplishments, again, you want to describe your new programs certainly and expenses, grants. When we talk about expenses, we're not talking about grants that came into you for the organization. We're talking about grants that you spent. So you're going to see expenses, that's the grand total, and then we say including grants up, that's how much you've gifted away under this particular program. Okay? And then revenue. And then we're also going to check some boxes here. Did you cease conducting or make significant changes in how you conduct your program? Again, the answer to that question may also indicate some sort of shift in your mission. So depending on how you answer that question, you want to put an attachment, and they're telling you to put an attachment in Schedule O. Okay? Do you have any brand new programs? And then you're going to disclose your 3 largest programs. They may not have 3 large programs. For example, a school, their main program, if you will, is education. So you may see one thing that talks about the educational resources that they provide. Now we begin the great checklist. So here we're going to talk about checklists of required schedules. This is where you're going to see whether or not an organization should be completing one of the attachments. And it tells you exactly which attachment you would file. So it says if you check yes to this question, you should be filing Schedule A or Schedule C. And it goes on and on and on from there. And so what we're talking about here is Schedule A, which is the test to see whether or not you are a public charity. Most organizations, need to attach that. For the most part, it's very rare that you're going to see a 990 without Schedule A being there, right? Schedule B is going to be schedule of contributors. And again, for the most part, you're going to see Schedule B. Schedule C is really for political campaigns. Again, nonprofits, 501c3s are not really supposed to be heavily involved in political activities. So you probably won't see Schedule C unless they've made a special election, in which case you might see it, or they've made sure to stay under the threshold. And then we start getting into some of the other ones. Schedule D. You should almost always see Schedule D as in dog. Schedule D is basically a reconciliation between the financial statements of an organization and the tax return numbers. It's also where the endowment information is. It's where the information is about the fixed assets. It also carries some information about other investments that are significant in size or other liabilities that are also significant in size. So Schedule D as in dogs is another one of those schedules that you should almost always see. And it's a really good resource to, as you start looking at the 990, pull that apart and actually put it next to you because it's going to help explain why the numbers in the tax return may not look the same as the numbers that you've been looking at in their financial statements. Okay, so that's a really good, it's almost like a cheat sheet, if you will, to explain what's going on with this organization if the numbers seem strange. Okay. And then a couple of other things that are in there are the questions regarding whether or not you had activities outside the United States. And the IRS and the Department of Treasury are very interested in this. They're very interested in tracking money that leaves the U.S. and why it's left the U.S. and have you done the necessary reporting. So again, if they check yes to this, this may not be because they're doing grant making outside of the U.S. or it might not be because they're running a program outside the U.S. It might be because they have a foreign investment. Okay, or they might be checking yes to this because they have an employee operating out of an office in some sort of foreign country. So they have a presence outside the United States and they're spending money, let's say, on the renting of the office or whatever it might be. And then if you check yes to that, you're going to disclose on Schedule F the amounts and the nature of what you've been doing there. But again, every single one of these schedules has a different threshold. So here, you know, we're talking about foreign investments over $100,000, but a grant may only have to be over $5,000. So it's very important for you, when you're looking at this, to understand that the disclosures may range in size depending on the threshold that's been set for the question. So you may see a disclosure of a very small grant, but you may be missing a significant investment because unless it was over $100,000, it didn't have to get disclosed. This is always important to take a look and see whether or not they were able to answer these questions and check yes. So they ask you about your payroll and your 1099s. And they literally say, tell me how many 1099s you've filed. Box 3 of Form 1096 is basically telling the world how many 1099s I filed this year, right? If they put 0 to that, typically that would be a little surprising because remember, the people that get 1099s are those that are set up as a sole proprietor, an individual, or a limited partnership or limited liability company that has flow-through tax treatment, right? So usually you at least want to cut a 1099 probably to your law firm because it's a limited partnership. Your accounting firm is probably a limited partnership, usually some sort of consultant, maybe a construction contractor. So if they put 0 on here, that's usually a little surprising, but maybe for some reason they didn't have anything that was material for a 1099, or maybe they only used organizations that were incorporated and therefore they didn't need a 1099. They ask you the number of Forms W-2 included in 1A. So when we're talking about, oh, I'm sorry, let's skip to 2A where it says the number of employees reported on W-3. When we're talking about the number of employees on page 1, it should match this, which is the number of W-2s that you filed for the year, which means that you're not disclosing the number of employees at the end of the year. You're disclosing how many employees you have throughout the year, right? So the way that the software works is that 2A automatically flows up to, where is it? I'm sorry. Oh, okay, it comes a little later. I got too excited. Okay, this box will actually match another box that'll be the number of employees, but it's not the number of employees at the end of the year again. It's going to be the number of W-2s that you cut during the year. Okay. And then it says if at least one is reported on line 2A, did you file all the federal employment returns? And if they check no here, you definitely want to go to Schedule O and find out why, right? I mean, we want to know what happened. Maybe there's a timing issue or something went wrong, or maybe somebody else files on their behalf and they're explaining that in Schedule O. When we talk about governance, management, and disclosure, again, here we're going to find out about board composition, relationships, fraud, documentation of meetings, compensation, who's reviewing the Form 990, conflict of interest, whistleblower, documentation. All the things that the IRS actually has no jurisdiction to govern, but all the questions that they thought the public should know about how this organization is being run, what type of governance policies they have in place, and basically the composition of who's governing it, who's sitting on their board, what type of relationships do they have with the organization or with a related organization. So here we talk about local chapters, branches, or affiliates. And then this is a big one, 11A. Has the organization provided a complete copy of this Form 990 to all members of the governing body before filing the form? This gets a lot of press because what the IRS realized is the board very rarely saw the Form 990 before it was filed. Typically, management would review it. They'd work with their accounting firm to go over the numbers. It would get filed, and then subsequent to it being filed, it would get dispersed at some board meeting, and they would say, oh, guess what, we filed on time, and here it is, right? Or maybe they didn't do that at all. And so one of the things that was considered good governance is giving people on the board an opportunity to see the form before it goes out, because maybe they can catch mistakes. For example, maybe that they know they gave a significant donation that is bigger than the ones being disclosed on Schedule B, and yet they're not on Schedule B. Or perhaps they realize that they have some sort of relationship with another entity that would create a related party transaction, and that's not being captured here, right? So the idea was, let the board look at it before it goes out and give them the opportunity to catch any mistakes or give their input, and then the form would go out. The problem with that is that nonprofits got a little murky about the board seeing, for example, all the compensation information, although, you know, for the most part, they should know those numbers anyway. And so they felt very strange about the board seeing all the pieces of the form. The IRS has been extremely clear that in order to check yes to this question, the board has to see the full and complete form. You cannot redact certain pieces of the form, okay? So, and also it can't be a committee of the board. They specifically asked, did all members of the governing body. So it can't just be that the audit committee saw it acting on behalf of the full board. The full governing body has to have the opportunity to see the form in order to check yes. If you check no, nothing's going to happen to you, right? I mean, there's no penalty for checking no. But again, the idea here is, well, if we put it out there and, you know, watchdog agencies are now giving ratings based on how you answer these governance questions, you're going to want to check yes. So this is going to kind of shame you into making sure that the board gets to see it. There are ways to do that and still get the form in on time, because obviously some of the governing bodies of nonprofits are gigantic. So ways to do that, some of them have sent it electronically. Another way is basically at the general board meeting to basically, you know, pass the forms around. Does anyone have questions? One of the things that we do with a lot of our clients is our client will circulate it to the board, and we'll give a deadline for comments. You know, we plan to file on the 15th. You have until the 13th to come back with any questions or any comments. If we don't hear from you, it's going to get filed by the 15th. And that's a good way to kind of wrap up the process. There's nothing in this question that says that they have to vote and approve the 990. That's very important. There's nothing here that says that there's an action of the board that needs to be taken. All it says is that they have to be given the opportunity to look at it before you file it. Did the organization have a written conflict of interest policy? That's easier to check than the second one, which is were they required to disclose annual interest that could give rise to conflict. So I have plenty of organizations that have a conflict of interest policy but haven't been signing the forms on an annual basis, right? This is really important. Forget the watchdog agency's ratings and forget, you know, what the IRS thinks. This is simply good governance to have the board members and key employees on an annual basis disclose the conflict of interest so that you know when you're entering into a related party transaction. This form in several different places specifically asks about related party transactions. You won't know the answers to those questions if you don't have a recent completed conflict of interest form from everyone that would be affected. So you simply can't answer those questions if you don't get the information on an annual basis. So it's very important for those organizations that are checking no to this to try to inspire them to start doing it on an annual basis. In addition, for those organizations who are incorporated in New York and therefore fall under NIFA, that endowment law specifically asks that for the investment, that conflict of interest be signed on an annual basis so that you would know if you had a conflict of interest with one of your investment managers. So actually, for those that fall under NIFA, if they're not doing this on an annual basis, they would not only check no to this, but they would basically be breaking the covenants of NIFA as well. Okay, so it's important. Did the organization regularly and consistently monitor and enforce compliance with this policy? Hopefully, yes. Did the organization have a whistleblower policy? Hopefully, yes. Document retention and destruction. Did the process for determining compensation of the following persons include a review and approval by independent persons, comparable data, contemporaneous substantiation, and deliberation and decision? And then they specifically identify the CEO, the executive director, or top management official. You'll remember a couple of minutes ago when we were talking about what's changed for 2011, I mentioned the question about determining executive compensation done by a related organization. And I said it's in Schedule J. And this is not Schedule J, this is the core form. That is because right here you have this question. When we get to Schedule J in our next session, they have almost the exact same question again in Schedule J. And again in Schedule J, they ask you to explain how you did this. So that's part of the form that's a little redundant. They're basically asking for the same information twice in the core form and then again in Schedule J. But one of the reasons being, not everyone has to file Schedule J. So for those organizations that have to, you might see the same information twice. But some organizations, this is the only place where they would have been able to get at that information. Okay. Other officers and key employees of the organization. So here, 15A is just asking about your top executive. 15B is saying, what did you do to come up with the reasonable compensation for other officers or key employees? Again, this is so important because this is one of the biggest things in the marketplace is reasonable compensation. It's probably something that you want to look at when you're reviewing grantees because this is probably the big budget item. How much are they paying out in salaries, and is that compensation reasonable for what they're doing? You know, again, it's always very sad, but the truth is when nonprofits hit the headlines, it's usually because something went wrong. And usually what went wrong is that the CEO was being paid some exorbitant amount of money, and the nonprofit was unable to do the programs that it was intended to do while this person, you know, did something outrageous, was flying in a corporate jet, was traveling first class, whatever it might be, and also collecting $500,000 for salary. So pay attention to this line, pay attention to what policies they're doing. If they say that they've checked and they're comparable with other organizations, you'll know right away whether or not because you look at multiple organizations, you'll know whether or not they seem in line. Governance, management, and disclosure. Here we talk about what states would you be filing a copy of this 990 form in. Public inspection, we're going to talk about that in 1 second. And then public disclosure of governing documents, conflicts of interest, policy, and financial statements. So a couple of things on this page. States that you would file a copy of the Form 990. There are multiple reasons why an organization may be filing a 990 in, let's say, 10 different states. The main reason would be because they are fundraising in those states, okay? And it's very difficult for organizations to figure out whether or not they need to be filing in a particular state. If they get one contribution from, let's say, California, do they now need to start filing in California? So again, there are thresholds for what would trigger filing. But what we usually tell our clients is if you start to see a predominant amount of contributions coming in from a particular state and it's a recurrent pattern, you should probably start filing in that state. The idea is, of course, that you want to be upfront and start filing in a state rather than they come looking for you and you get that letter in the mail that says, hey, I think you've been doing business in our great state of California and here's your bill, right? So you do the filing on your own. Hopefully you just pay the registration fee and it's fine. So no big deal if you see that they're filing in multiple states. Perhaps they're doing some sort of investment activity in another state, or perhaps they have employees in other states, and since they're filing employment forms, they are required to file in those states as well. In terms of whether or not you make your Form 1023, 990, and 990T available for public inspection, when this question first came out, everybody was checking the box that said another's website. Why? Because GuideStar posts this information. The IRS came out and said that doesn't count because you guys had no choice about that. So it's not that you made it available on another website. That's automatic, right? So in order to check yes to this, and you have to be very careful because I had a client get in trouble for this actually. If you are going to say you make it available on your own website, you have to post the full form. I had a client that checked the box and said our 990 is on our website, and they decided to pick and choose which pieces of the 990 they put on their website, which it's their website, they can do whatever they want. Should not be a big deal, but there was a reporter who saw on the 990 they checked that box, went to their website, saw it wasn't the full 990 and called the IRS. And then the IRS called the organization and basically said, don't do that. So, I mean, they didn't have to pay a penalty, but according to the IRS, if you're going to check that box, you should really put the full form. Instead, since it is your website and you can put up whatever you'd like on your website, if you want to put up just certain pieces in 990, by all means do that. Just don't check this box. Okay. The other thing is, in order to check yes to this, it's asking you whether you put all three of these things on your on your website or on another website. It's very rare that I've seen my clients put their Form 1023, which is their original request for tax-exempt status, out to the public. I mean, it's a lengthy document. It's a very old document for some organizations, probably not electronic. So you're probably not going to see people checking yes to this because they don't make their 1023 available. They're happy to make their 990, but not the 1023. So if they don't make all three, they can't check yes. So fine, put it available upon request. And then in Schedule O, you want to describe whether and if so how the organization makes its governing documents, conflicts of interest, financial statements available to the public during the tax year. Again, very important when you answer this question to be honest and say, if you're going to write the answer to this question is they're available upon request, then you could have a reporter call you up and say, I'm requesting it. And then you can't say no, right, because you've just said that it's available upon request. So there's no harm in saying we don't give out our governing documents, right? You're not required to, and you know it's not necessarily anyone's business. There's no requirement. So you might say here, our conflicts of interest is available upon request, our financial statements are available upon request, our governing documents are not made available to the public. And there's really nothing wrong with that. It's protecting the organization. And then here you just want to name the physical address and phone number of the person who possesses the books and records of the organization. Okay. So how does the IRS define independence? So I said it as a joke, but it's actually very true. I always think independence in terms of the IRS means the land of the free, and I mean that very literally. They attach a very financial aspect to what they think is independence. So here, when I ask you for the number of independent voting board members, this number may not match the number above it. So you may see they have 23 voting board members, but they only have 21 independent voting board members, and that's okay, right? You know, there's not necessarily something wrong with that, but hopefully somewhere, probably later in the form, you'll see why 2 of the board members were not independent, right? So very important to know how they are defining it. And they define it based on these definitions, that the member was not compensated as an officer or other employee of the organization or of a related organization. So if they have a brother and sister relationship with another organization and this board member is paid by that other organization, their independence is now impaired. Okay. If they get paid by the organization for serving on the board, again, they may be impaired. But again, here, the payments would be exceeding $10,000. So if they got some sort of reimbursement for travel being on the board, that doesn't impair their independence. So a member did not receive total compensation or other payments exceeding $10,000 during the organization's tax year from the organization or related organizations serving as an independent contractor other than reimbursement of expenses under an accountable plan or reasonable compensation for services provided in the capacity as a member of the governing body. So again, if I'm serving on your board and I am a lawyer and my firm is providing some sort of reasonable service to you, because if not for that, you would have had to have gone out and hired another lawyer, that may not necessarily impair my independence. It depends whether or not it's over $10,000. Depends whether or not I went above and beyond my duty as a board member. But those are some of the things that might be okay. Neither the member nor a family member of the member was involved in a transaction with the organization, whether directly or indirectly, through affiliation with another organization that is required to be reported in Schedule L for the organization or a related organization. We're going to talk about Schedule L in our next session, but Schedule L is basically a schedule of interested persons, right? And so interested persons is basically going to be people that we would have thought of as board members, highly compensated, or key employees that had some sort of transaction with the organization that maybe impair their independence, or maybe they have a loan. Maybe the director of finance has a loan from the nonprofit. That's going to go on Schedule L. So Schedule L is a great place to look for these sort of related party transactions that I was speaking about. And we'll talk about this in our next session, but there's two places where you'll see related party transactions, Schedule L and Schedule R. The difference is Schedule R is on an individual level, right? So it's that the organization had a transaction with Bob, and Bob is our CFO. Schedule R is that our organization is related to another organization. So it's on an organizational level. It's talking about what other 501c3s or 501c4s or disregarded entities we are related to. Okay? And then the fourth definition is neither the member nor family member of the member was involved in a transaction with a taxable or tax-exempt related organization of a type and amount that would be reported on Schedule L if required to be filed by the related organization. And again, Schedule L is one of those things that has different thresholds for different moods, right? So if the CFO's wife is working at the organization, if she's compensated $1 more than $10,000, it goes on Schedule L, okay? But if a board member's firm is being used by the organization, the threshold might be $50,000. So the reason why I keep saying is the threshold required by Schedule L is because depending on the type of transaction, the thresholds change. Okay, but really important, if you flunk any one of these four things, you are not independent. Okay, the IRS decided to do a study to see whether or not the answers to the governance questions made any sort of difference in terms of whether the organization had a fraud lately, or whether the organization had any sort of difficulty in terms of how they answered these questions, these governance questions. And what they found was those organizations that had a lack of independent board members, so let's say they were 23 board members and 19 of them weren't independent, that did not necessarily have any sort of implication in terms of how well they were run. Okay, so again, the nonprofit community always struggles to find board members. It's a volunteer activity. It's incredibly time consuming. There are many board members who sit on numerous boards. That could create a lack of independence, and that's not necessarily something that's bad, right? You know, perhaps the fact that this person sits on multiple boards gives them a background and experience that makes them a valuable board member to your organization. So just because they say that their board member has a lack of independence doesn't mean that it should have a negative connotation. Okay. Based on the definitions, it appears that a person having a financial interest or personal gain is what impairs independence per the IRS. So we're often asked questions about whether the following scenarios would impair independence. If you are serving on a board and your firm provides legal services pro bono to the entity, are you still independent? Yes. If you serve as a director for the school that your child is currently attending, are you still independent? Yes. If you serve on the board of a related entity but are not compensated by either entity, are you still independent? Yes. So again, it seems to be the exchange of dollars that causes a lack of independence. Next, we're going to talk about compensation. And the reason why I wanted to talk about this section in particular is I think compensation throughout the Form 990 is probably one of the most confusing things because the year end that you're reporting on changes throughout the form, and the amount that they're looking for also changes throughout the form. So I really wanted to kind of focus on Part 7, which is part of the core form. And it's the compensation of officers, directors, trustees, key employees, highest compensated employees, and independent contractors. Okay. So here we have this great little schedule where we're going to list their name and their title. And we're going to talk about the number of hours that they worked for this particular organization. And also in the form, they're going to ask you how many hours did you spend working for a related organization. Okay. In this case, the related organization is going to be an organization that fell into the criteria for Schedule R, which means that not just an organization where you had one overlapping board member. It has to be an organization where control is involved, right? So it has to be that there's an organization where the board members of your board make up the majority of somebody else's board also. or where your board has the ability to elect every single board member on their board. Some sort of control over another entity is typically what makes you related to that entity. So here what we're saying is, we're just curious. We know that you work 40 hours a week, but you also work for this other organization. How many hours are you spending working for them? And then here we talk about the position. And it very clearly says do not check more than one box unless the person is both an officer and a director. The reason why they are putting that in the instructions on the core form itself is because I can't tell you how many times I look at 990 and every box is checked, or like 3 boxes are checked. They are basically mutually exclusive boxes, right? And they're giving you the only scenario where they expect to see 2 boxes checked on a particular line. And that is, I serve on your board and I'm the president of the board. So I am both an officer and I'm a trustee. Or I am the treasurer of the board, or I'm the vice president of the board, whatever it might be. That's the only scenario where you would see 2, okay? In terms of officer, there's a definition provided by the IRS. Key employee, again, there's a specific definition provided by the IRS, and we're going to go through that. People get very offended by that. They want to list somebody as a key employee, and I explain that this particular person doesn't meet the criteria. And they said, but no, but they are an integral part to what we do, and they have to be shown as key. And I try to explain that it in no way is to demean them or say that they don't work really hard, but that designation has been defined, and so we have to follow the criteria. If they are not necessarily a key employee, they may be one of the highly compensated. Okay. Again, this particular schedule has compensation reported on a calendar year end, no matter what your year end is. Okay. I could be a junior end, but every number that's going to be in here is going to be on a calendar year end. That's why it's referencing the W-2, the 1099, because it's telling you to pull those numbers from there. So this is where they now specifically say reportable compensation, box D, is either going to be box 1 or box 5 from that person's W-2, depending on which one is the higher amount. Okay. And the very annoying part is, remember, I'm a June 30th, 2012 year end. That means I'm filing a 2011 form because the form matches the first day of my fiscal year. So the first day of my fiscal year was July 1st, 2011. So I filed the 2011 form. That means I need the 2011 W-2. That gets very confusing to my clients when I ask them for that, because we're in 2013 now, so they want to give me their 2012 W-2, but it has to match the filing year of the form. So I'm giving you basically old data on their salary, but that's what the form, the year we're looking at. So I'm going to take the 2011 W-2, the 1099, and estimated amount of compensation from other related organizations. So again, if I'm getting paid by that other entity, it's going to show up in box F. And so here, the other thing I just want to point out is typically I either get a 1099 or I get a W-2. I don't get both, right? Maybe I terminated my employment during the year and I therefore became an independent contractor. So there's a limited instance where I would get both. But what we found is some organizations don't necessarily understand the definitions and that you're either an employee or an independent contractor. So they're cutting multiple forms to the same person. If that happens, what should be in box C is the sum of those forms, right? So if for some reason somebody got a 1099 and a W-2, the sum of those 2 amounts is what's going to be in my box C. It has to be all reportable compensation, regardless of which form it got put on. Okay. So the IRS has specific criteria for who gets listed on the form, and here are a few things to keep in mind. You're going to list all trustees, directors, and here we're talking about voting members only. I'm often asked if, honorary members of the board get listed here, and if they don't actually have a vote, they don't go on here. The IRS is very specific about that, because otherwise these lists would go on for years and years and years. So only those that actually have a vote, and you're going to list people that served at any point during the fiscal year. This gets a little confusing because a lot of organizations switch their board members mid-year doesn't necessarily match their filing year. So because of that, I'm going to have anybody that served a single day on my board listed here. So I'm going to have potentially old board members and new board members. It doesn't mean those board members that were serving at the end of June 30th, 2012. Okay. So again, one of the things that's important to know is on page 1, it asks you how many voting board members you have, and that actually is specifically at the end of the year. They tell you, they want to know at the end of the year how many people sat on your boards that were allowed to vote. In this schedule, they're asking you who served during the year. So in this schedule, you may end up with 26 board members, but page 1 only shows 23 board members. And again, that's because of the different definitions and the different criteria that you're using. Important to know that basically 23 people at a given time serve on their board and vote. That's really the key thing to take away from here. And then the names, they're just going to show you who was in and out during the year. So we've talked about the fact that elections could occur mid-year, and therefore you would show both the new and the old board members. When you check the box former, what happens is because you're asked to report people that served at any point during the year, if I had a CFO who was terminated mid-year and I had a new CFO, I might actually list both CFOs in this schedule because the definitions tell me that I should, right? There are ways to kind of explain that. Right next to their title, you could actually put start date, 1/1/2012, or give some sort of explanation as to why I've got CFO. But you actually have to list both. So the question then becomes, for the one that left, do I check the box former? The answer is no. The IRS specifically says that that box is meant for someone who didn't serve a single day during this particular year. This is somebody who received compensation even though they're gone. So they're really looking for severance, right? So if you check this box, to them, but you're basically saying is, we're still paying somebody that hasn't worked for us this entire year, okay? So that's the only time that that box should be checked, and that's something that often is done wrong. Okay. Organizations struggle to determine who should be listed as a key employee. And a reminder, there's a specific definition for key employee, and you have to meet these 3 criteria in order to be designated a key employee. First, the responsibility test. So you're going to put any person who has responsibilities, powers, or influence over an organization as a whole that are similar to those of an officer, director, or trustee, or who manages a discrete segment or activity, or who has authority to control 10% or more of the activities, assets, income, or expenses. So basically what we're saying here is somebody who has control of their own budget, if you will, could present to the board the budget for their particular segment, somebody who really has a lot of responsibility within the organization. A lot of times, for example, in a school, this might be because you have a middle school, an upper school, and a lower school. Each one has its own dean, right? So that dean carries a lot of weight, and they go to the board and say, this is my operating budget for my particular school, and I want your stamp of approval. So they're controlling their own business segment, right? The second thing, and this is where most of the time the people that my clients question me about flunk, is they have to receive reportable compensation in excess of $150,000. If they don't, they are automatically, no questions asked, not a key employee, no matter how responsible they are or how much they do for the organization, right? So when we talk about reportable compensation, this does not include the health insurance that the entity pays on your behalf. It doesn't include, let's say, the contributions to your defined benefit plan or whatever it might be. This is reportable compensation that showed up on box 5 or box 1 of your W-2 on that 1099, the amount that you're going to pay tax on in a given year. That's what puts you over this threshold. Okay. And then top 20 test. So the person that's being designated as a key employee would fall within the group of the 20 highest paid employees, all of whom would have to be above $150,000. If you don't meet all 3 of these, then you wouldn't be a key employee. Okay. So then the question always comes to me, well, who's an officer? And the officer is defined as a person elected or appointed to manage the organization's daily operations at any time during the tax year, such as president, a vice president, secretary, treasurer, and in some cases the board chair. The officers of an organization are determined by reference to the organization documents, bylaws, or resolutions, but at a minimum, officers are those that would be treated as officers by applicable state law, which would basically be your top management official and your top financial official. So what this is basically saying is your executive director, by definition, is an officer. And whoever your top financial person is, they are by definition an officer. It doesn't necessarily go by their title. So whether you call that person director of finance, CFO, controller, comptroller, whatever that title is, if they are the highest financial person at the organization, they are an officer, okay? I like to think of it, although this is not in the instructions, but I like to think of it as who could act as an agent for the organization? Who has the authority given to them by the organization to basically sign a contract on behalf of that organization? Because they have the legal authority to act as agents, right? Probably they're an authorized signer on my bank account. You know, those types of things where they've been given the legal responsibility by the board to enter us into a contract, a binding contract. Those are usually who I think of as officers. And then in 2011, the IRS clarified in the instructions to the core form that you only check one position. We talked about this unless they are both an officer and a trustee. And then, as noted in the IRS Form 990 glossary, if a name is listed in the signature block or as principal officer in the heading on page 1, that person must get listed as one of the officers in Part 7 in the following year. Okay, so let's talk about this for a second. So now your 990 is ready to be filed, and you need somebody to sign. And you can't get a hold of any of the officers of the board, and the executive director is on vacation. And so who are you going to get to sign this, right? So you ask Bob to sign it. By virtue of the fact that Bob signed your 990 as the officer of the organization, you have just empowered him to become an officer. So next year, the IRS is going to look for that person's name in your officer list, because that person was important enough to sign your 990. They must be really important to your organization. So you want to be very careful about who you allow to sign the 990, okay? Okay. After you've determined and you've listed out your directors, your officers, your key employees, the next thing that you're looking for is highest paid. And they tell you that you're going to list the 5 highest paid, and they give you the threshold of $100,000. Again, $100,000 reportable compensation on a calendar year. So $100,000 based on a W-2 or a 1099. Okay? So the question is, why are only some of the names that get listed on Part 7 of the core form then transferred onto Schedule J? And we're going to talk about Schedule J in our next session. But a lot of times people hold those next to each other and they say, look, you had 12 employees here and only 3 of them made it to Schedule J. Well, in Part 7, they define highest compensated as anyone over $100,000. Schedule J says we only want to see people listed that earned over $150,000. So they changed the threshold for the attachment, so it's really just those super highly compensated people to kind of scope out the general population, okay? So you may not see the same names in Schedule J, and that's okay because the thresholds are different. Another question I get is on page 10 of the Core Form 990 is that wonderful functional expense schedule that I know you all love with its multiple columns and numerous lines. And on there is a line that says compensation of officers, directors, key employees. Below that, compensation of other employees. And there's numbers there. Why are those numbers not necessarily the same number that you would see in Part 7, column D? And the answer is, again, in Part 7, they asked me to do it on a calendar year, right? On page 10 in my functional expenses, those are the same functional expenses that you would see in my financial statements. Those are on my fiscal year. right? So yet another place where compensation is reported in a different way. See why I get confused with this? See why I say it's the many faces of compensation? Because it just keeps changing on every page. So again, don't be concerned on Part 7 when I listed all the compensation that it doesn't match the functional expenses. It very likely will not match the functional expenses. Okay? So talking about page 9, the statement of revenue, this page actually does a lot of things all in one place. It combines page 1 and page 8 of the old form into one schedule. It's not significantly different, it just puts everything in one place. When I say must use business codes only if you have something in column C, which is the unrelated business revenue, okay? Using the business codes for your program or your related income or your excluded income is not required as of now, okay? It's still out there. They haven't taken the codes off the form, and they still give you the reference in the instructions as to where you can get the codes. So it may at some point come into being that you have to put codes for everything, but right now it's just required for column C. So what we're going to do on top is we're going to give you a snapshot of basically all the contributions that we raised, but we're going to tell you where they came from, right, which is great. So we're going to talk about membership dues. We're going to tell you any sort of special event fundraising money that came in. We're going to tell you if a related organization gave us money. We're going to show how much came in from government grants. And then item number G, letter G, non-cash contributions. This is not in addition to. This is a subset of what you've already shown above, right? So if somebody donated a car to you, the value of that car is up above in 1A through 1F. But now we're just letting you know that, by the way, there's a number up above that wasn't actual cash. It was a donation of a good, okay? And so then we get to schedule, we get to the total H, okay? That's how much we raise in terms of contribution revenue. When I look at H and I figure out either 2% of that amount or everything over $5,000, that's the amount then that I'm going to start to look for in my Schedule B, where I list my highest contributions, okay? We're going to talk about that in a little bit, but on Schedule B, you have the option to do 2% of total contributions and just list those donors that gave more than that amount, right? So when you're doing that, it's 2% of what? It's 2% of page 9, 1H, okay? Which means, by the way, I'm always asked, would you list the government gift on Schedule B? And the answer is yes. So, for example, a school that got New York State mandated service reimbursement, that would be on Schedule B. It might be one of the highest amounts that they receive. Below that, we see program service revenue. Again, we're being given the opportunity to describe the program. So we can type in that this is for our summer program. We can type in that this is for, you know, our driver education, whatever it might be, and then show the columns that it belongs in. Typically, in column B is going to be the income from everything that you typically do in terms of program. Column C is going to be those unrelated business activities. That might be investment income from a particular K1, let's say. So if I'm in a limited partnership, sometimes those trigger UBIT, and it's a pass-through effect. So I have no choice about reporting it. In fact, I might not have even known it was going to happen. I got this Form K1 at the end of the year, and it says, by the way, you have unrelated business income tax, and here's the amount, okay? So that might be what's in column C, or it might be that, you know, I have all these extra rooms, and I've decided to turn that into a business. So in addition to, you know, my educational mission, at night I rent out the rooms and I provide catering, right? So I've created a side business that has nothing to do with my mission. I'm earning income off of it, and I've determined that it's unrelated, so maybe that's what goes in column C. Column D is usually going to be interest and dividends, all that sort of extra income that is not necessarily a problem, right? I mean, you're completely allowed to earn that, but it's not related to a program, so it's not in column B. Okay. The functional expenses, I know you guys love this one. So very similar to what you're used to seeing. And here, I want to point out, because this is a difference for 2012, the IRS really wants you to use all the wonderful categories that they took the time to list, right? And typically what happens is organizations don't want to do that. They don't want to necessarily tell you what they spent on a professional fundraiser or what they spent on investment management fees. So they list out the ones that they want you to see, and then they plug everything down in other, right? The IRS said, we're going to figure out a way to stop this practice. So we basically said that whatever goes into miscellaneous cannot be more than 5% of total expenses. Well, actually, that's a pretty high number if you think about it. If you have significant expenses, 5% is a big number, so there's still a lot of ability to hide things down in other. So in 2012, they got even smarter, and they said, okay, let's try this again. We're going to keep the 5% rule, and then we're going to say that if you put things in other, which normally you wouldn't see on page 10, we're going to make it go to Schedule O and break out every single other thing that was in other, okay? So that's actually not for the tax returns that you guys are going to be seeing during this year, because you're going to be seeing 2011. That's something that's happening for 2012. But it's actually a really good thing because it's just greater transparency, okay? So what's probably going to happen is you're going to see a move to more people using the categories that they should have been using anyway, right? And then we all know about the need for ratios, right? So you're taking your total expense and you're allocating it. How much is related to program? How much is related to management in general? How much is related to fundraising expense? There are organizations that say they don't have a single dollar of fundraising expense, and yet they have a development department. So I always get very confused by that. But you should probably see something in that column. I know people are very nervous to put too much there, but it makes sense. I mean, you have to bring in revenue to your organization to keep your doors open, right? So one of the things that the form will ask you about later is, do you have any joint cost allocations? And I'm often asked, what does that mean? So the best example I can give you of a joint cost allocation is something that serves a dual function. So for example, I'm a membership organization. I send out a program letter to all of my members, right? And it really is just to inform them about everything that we've done in the past month. But on the back of that program is a tearaway card that they can mail in along with a check, right? So that program letter actually served a dual function. It was programmatic in nature, and it was fundraising in nature. So I now have a joint cost allocation, because I'm going to take the cost of that mailing and I'm going to spread it to these two, because it really served a dual function. Okay. So that's one of the limited examples where I have something that really got split. Okay. Allocating somebody's time, if they spend a couple hours doing fundraising, that's not necessarily a joint cost allocation, right? Because they can literally say, I spent 4 hours here, I spent 5 hours there. It's more so where you have one product that you had to make an arbitrary determination as to how much you were going to put into fundraising and how much you were going to put to program. Okay. So if you have that, again, not a big deal, but you would just check the box and you would just explain what it was, right? And that you felt that you did a reasonable methodology to allocate that particular cost. Okay. Here we have the balance sheet. The good news is that it used to be that you saw a lot of attachments for the balance sheet. You know, a definition of everything that was in my prepaid, a definition of every single thing that was in my investment. And now what they've done is they've tried to break out the investments, to carve them out so that you don't have to do an attachment. You can just say, these are the investments that were publicly traded securities. These were the investments that were considered other. These were my program-related investments. So hopefully you don't really have attachments, right? So typically now we've got all the different categories and we can look from year to year. For fixed assets, we're giving both the cost basis, the accumulated depreciation, and coming up to the total that goes on line 10C. And then they're telling you, for example, line 12, other securities. Here's where if you have a significant amount on this line, you might see in Schedule D an explanation as to what that other security was. Okay, and they give you a threshold. It has to be a certain percentage of your total assets. But again, if you see a huge amount on this line, again, grab that Schedule D, which you really want to have next year when you're reviewing the return anyway, and see if they tell you what that was. Okay. same thing when we get to the liabilities. Oh, I skipped over that. Okay. I didn't give you a picture of the liabilities, but right beneath here is the liabilities. There's a line that says other liabilities. If that's a gigantic number, again, in Schedule D, they're required to tell you what that was. A lot of times what that's going to be is their post-retirement benefit adjustment, okay? And again, that's an actuarial calculation. They have no choice as to what that number works out to be. It's an other liability, and they'll explain it to you in Schedule D. Reconciliation of net assets. This is the part that's in the core form. So this is a very abbreviated part. It's just going to say total revenue, total expenses to give me my net income. And then it'll start with my beginning balance. And then it will say other, right? And it won't tell you what other is. So other changes could be, and most likely are, your unrealized gains or losses. Because your unrealized gains or losses is not actual revenue to the organization. It's actual cash in the door. So that's a change that you might see in other. But this particular schedule doesn't give you a lot of explanation as to what's sitting in that line. That's because in Schedule D, it gives you tons of details as to how we got from the revenue that was in the financial statements to the revenue that was in the tax return, how we got from the expenses in the financials to the expenses that are here, and it gives you a detail of what they consider other. So those are two things they'll have next to each other. Then finally, in this part 12, they're going to ask you whether your financial statements were compiled or reviewed or audited. You should not have box 2A and box 2B both checked yes. I see that all the time. You are either compiled or reviewed, or you're audited. You can't be both, right? So I think what happens is people read the first one and they say reviewed. Oh yeah, somebody looked at our return. Somebody looked at our financials, but they don't realize that the next question is audited. So one or the other, hopefully the answer is yes. And then this is very important, 2D. It asks you, are you consolidated with somebody else? Okay. Are you presenting your financials on a separate basis, on a consolidated basis, or you present financials on both, right? So if I am a supporting organization of another entity, right, I am consolidated within their financials because my mission is to support them, right? They control me. I'm housed within them. There's no reason why I have to have standalone financial statements. I have to file my own tax return because I have my own tax ID number, but I don't have to have my own financials. So that means that you might see financial statements that they consolidated where you couldn't possibly get at my numbers because I'm under their umbrella and I'm housed within them, right? So just knowing that, remember that you may not always get a set of financials that are really going to match this tax return if they haven't checked the box that says they're doing a separate basis, okay? And then finally, and this is also very important with nonprofits, due to the result of a federal award, were you subject to filing A-133? That is a separate audit that you would receive if you received federal money in excess. Typically, the threshold is about $500,000. So if you got federal money in a year over $500,000, you have a separate audit to track those federal funds and do what is basically a compliance test to make sure that you followed the letter of the law of the grant that you received, okay? It's a separate reporting requirement, and it's separate testing. So if they check yes to this, you know that they're receiving federal money, and you want to do the follow-up question of, did you file your A-133 report on time? Because if they didn't, or if they had findings in that report, their federal funding could get yanked, and that may put them in a very, very bad situation, okay? So just want to see if they check yes. Okay. Schedule A. So Schedule A is the public charity status and public support test. I say this, and I will say it again, being a public charity is a privilege, it is not a right, okay? So you have to prove every single year that you deserve the privilege of remaining a public charity. And how do you do that? You have to pass the support test. The support test basically says that you get more than 33 1/3 of your support from outside contributors, member fees, etc. the idea here is, by default, a nonprofit typically goes into the private foundation category, right? Which is not a bad thing, but private foundations, as you know, pay taxes, right? So to earn the privilege of not paying taxes, you have to pass this public support test. So the first page says, who are you? What type of entity are you, okay? And depending on which box you check, then defines what you're going to do on the next pages, okay? If I check the box that says that I am an organization organized and operated exclusively for the benefit of, so I'm looking at box 11, if I am a supporting org, I don't have to do the public support test, right? Because the entity that I'm supporting, that I'm consolidated in, is going to do that test. And it's well known that I'm just in the business to support them, right? Or they are supporting me, I'm housed within them. So basically most of my funding is coming from them anyway, so I don't have to go through this. Same thing with a school. So if I check yes to box 2, I do have to file Schedule E, but I don't have to actually go through the public support test because it's well known where all my money is coming from. It's coming from tuition, right? So depending on how they check the box is the next page. But what's important to know is this is Schedule A. This is the first page of Schedule A. It should be there, right? I may not have to do Schedule A, page 2, page 3 because I checked a particular box. But the first page of Schedule A should be there because I have to tell you what type of organization I am and whether or not I have to fill out the rest of it, right? Okay. So if you fall into the categories of 5, 7, or 8, you're going to complete part 2 of the public support test. Okay, so let's just go back so we can see. 5, so operated for the benefit of a college or university or operated by a governmental unit. 7, you usually receive substantial support from a governmental unit or from the general public. So most organizations are 7, right? 8, a community trust. So again, that's kind of like a donor advised fund. And again, you know, the general public certainly is supporting them, right? Okay. So 5, 7, or 8, I'm in part 2 of the public support test. And so this is an average over 5 years. And the reason why we do that is we understand that in a given year, you could have a very generous donor give you a significant gift. And so if it was based on a 1-year look, you might fail. Most organizations would probably fail because they can't control what's going to come in and they didn't know about this gift. And so what we do instead is we say, let's look across 5 years and see whether there's been one particular donor that's been making up the majority of your gifts for that year. And if that's the case, by the way, if that one person has been your substantial donor for all these years, there very well may be in your financial statements a concentration note, right? That one particular donor makes up 80% of your donations every year. So those two things may go hand in hand. Okay, but here we're going to take a look at gifts, grants, contributions, and the value of services or facilities furnished. And then we're going to basically try to get at how much was given by that one particular donor. We're going to call that the excess contributor. So we're going to take a look at all your donations across the 5 years, right, and come up with an average value. And then we're going to accumulate how much this one person gave for 5 years and see how much their gift was over the 5-year average. And it's the overage that then we're going to disclose, right? So let's say that I've got 4 donors, each of whom have been giving me $1 million a year, okay? So now I take a look at this and I've got $5 million from each one of these people. So for donor A, I'm going to do the $5 million minus the average value I calculated. And whatever that amount is, so let's say it's only $100,000, that's the overage that donor A gave me. So he's an excess contributor because over the course of 5 years, he's given me approximately $100,000 over what my average was. Then donor B, he's another $100,000. Donor C, he's another $100,000. So when I get to my excess contributor line, I'm going to have, let's say, $300,000, but it's going to be from multiple donors, okay? The detail of your substantial contributors is not available to the public. You don't have to provide that to the public. You actually just have to give that to the IRS, okay? So you will come up with this calculation. You will figure out, you know, who's my substantial contributor and how much is the overages. but the general public is probably never going to see that information and never know who those donors were. So for you, really, it's not finding out who the people are. It's just taking a look at how much that overage was and what percentage that worked out to be. So the idea here is that I have to be over 33.33% in Schedule A, okay? If I flunk that, because my 5-year average came in, let's say, based on all these excess donations, now they drove me down to being 20% given from the outside public, that might be okay, because I'm allowed to do something called facts and circumstances. So I'm allowed to attach something to the return that basically says, I flunked this year, but I flunked because, you know, Mr. Disney gave me a $20 million gift. It was a one-time thing. You know, we didn't know it was coming in. It won't affect us going forward. And you'll see that, you know, over the course of the next couple of years, I won't flunk again, right? And you can pretty much get away with doing facts and circumstances unless you go under 10%. If you go under 10% for this test, you're probably going to get in trouble. So you probably maybe want to consult with your auditor, your lawyer, and figure out your next plan. Or just go ahead and file the 990-PF and pay taxes for the year, right? So here we're just talking about excess contributions of the portion, and we're telling you the calculation that it exceeds 2% of the total amount. Schedule B, okay. So remember I talked about page 9, line 1H is my total contributions for the year. And so on Schedule B, where I'm going to list my top contributors, I can either do the general rule, which means I'm going to list every single person over 5,000, which may be a very long list. Or I might be allowed to do the special rule, and the special rule says either everybody over 5,000 or 2%, and that's the 2% of that line 1H. I would probably much rather do the special rule because I'm only going to have to list 5 people instead of 105 people. I'm only allowed to do the special rule if I satisfied in Schedule A that I met the public support test. Okay, so if I flunked the 33.33 for the year, I cannot do this special rule. Okay, so if I'm allowed to do this special rule, that's great. And so now what I'm going to do is I'm going to list all the donations I received on an accrual basis, which means it includes pledges. Okay, the form very specifically says Schedule B has to match whatever basis you filled out the rest of the form on. 99% of organizations complete the 990 on an accrual basis, which means that Schedule B is on an accrual basis. So if somebody pledged $10 million to me, I'm going to disclose $10 million even though they haven't funded the pledge yet. Okay? So just keep that in mind that you're doing a pledge basis, if you will. The other thing is you're aggregating the gifts. So if Bob Jones gave $5,000 12 times, I'm adding up all his gifts for the year and I'm disclosing that amount. Okay? This can be cash or non-cash gifts. So somebody could give me gifts of securities and it's going to end up on here as well. Okay? The other thing I also want to just point out is a lot of times people want to list anonymous because they don't want to put the person's name because the person asked to be anonymous. The IRS is not okay with that. The IRS basically says if you have knowledge of who the person was, you have to write their name. The only time it is acceptable to put anonymous on Schedule B is if the organization truly has no idea who sent them the money. Okay? Sometimes what you see is somebody that wants to remain anonymous may give you a gift through a community trust or through a donor advised fund. And so you may see a gift coming in from the Jewish Communal Fund or some sort of community trust. That's fine. You can list them as the donor because as far as you know, that's where the money came from. And there's nothing wrong with that. But if you have knowledge, you have to list the person. Okay? On Schedule B, I jumped. On Schedule B, very important to know that this is one of the only times that you're allowed to redact information, but not redact information for the form that you're filing with the IRS. The public disclosure form, the form that ends up on GuideStar, won't show the names of the donors. It will just show the amount. Okay, so this is the only schedule where the information that will end up on GuideStar will be slightly different than what got provided to the IRS. Okay, so the names of the donors won't be there, just the amount, and that's absolutely fine. You also do not have to give the individual's address. You can write care of the organization. In fact, you probably don't want to write their address on there. So you can just say, Bob Jones, care of the organization. Okay. Last thing I just wanted to talk about is what's new for 2012. We talked about a couple of things. The great thing is, remember I told you Schedule D, which is what you want to hold beside you when you're reviewing the return. One of the things that the IRS recognized is that those changes to the net assets that they're calling other are really important, and people want to know about that, and maybe that shouldn't be buried back in a support schedule. Maybe that should be in the core form. So they've expanded the reconciliation net assets now to break out what other would be. So now instead of one line that says other, you see it says unrealized gains or losses, donated services, investment expenses, prior period adjustments. So that information has been brought forward in the return because it's important to know how you get down to your final net asset number. Okay. Last but not least, I talked about those Schedule K-1s, which are those limited partnership investments. Originally, the IRS was thinking about forcing you to display the investment income within the return exactly as it shows up in the K-1. So dividends, interest, Section 988, foreign taxes paid, all those pieces would then have to go into your 990. Most nonprofits don't do that because they don't pay taxes on it anyway. So what's the big deal about breaking it out? Can I just show it all as dividends, or can I just show it all as realized gains? Does it really matter? And so the IRS backed away from this and basically said, for now, as long as you recorded the income somehow, we don't care about the pieces per se. They might come back to this, but for now they've kind of stepped away from that. That's it. We have one question? So the question is there scenarios where an organization does not have to file the 990, even a postcard? The answer is yes. If you're a religious organization, you may have an exemption from filing. There are a couple of others, but that's the one that most frequently comes to mind. And again, there are also religious organizations that may be covered under a group ruling, which means that the group, whoever the designated top person of the group is, they're probably filing a 990, but this particular entity that's covered by that group doesn't have to file their own, okay? But if you call them and you say, is there a 990, they may say to you, well, I'm covered under this particular group, and they'll give you the name of the entity, and you can find that filing entity. It doesn't really do anything for you, though, because their information won't be in that return. Okay. Great. Oh, one more question? Okay.
So I actually was just wondering if you could explain, as far as the fundraising line item where it says professional fundraising expenses and funds about the example of development staff, what is the executive director doing everything? You know, they're the only paid person in the organization. They spend part of their time on fundraising. What proportion of their salary would be reported? Would it correspond to the amount of time that they spend on fundraising, or is it because they're not dedicated fundraising staff?
Okay, so the question is about fundraising expenses and how would you allocate some of these time, especially if you have the executive director who's basically serving multiple functions and wearing many hats. And I just want to make one other clarification because you mentioned professional fundraising. So professional fundraising is when you actually hire some sort of consultant who's registered with the state as a professional fundraiser. And so you're going to put them on that line because you know that they've registered with the state. And that may be, for a professional fundraiser, it may be that you've just hired them as an event planner. So they're not actually doing anything in terms of mail lists or sending out letters to your donors. But because they've registered themselves as a professional fundraiser, you actually have to disclose them as a professional fundraiser and then explain that actually for you, all they did was plan your event, right? But now getting back to your question, so if I have an executive director who wears multiple hats and spends some of their time doing development, then I would absolutely try to do some sort of allocation of their salary. And you'll see that a lot. So, you know, the executive director is probably the best schmoozer you have, right? They're the face of the organization. The donors actually want to talk to them probably more than anyone else. So they may spend, let's say, 5% of their time, 10% of their time doing some sort of fundraising. And that's completely fine. And again, it's not going to be a perfect science, but they can probably tell you on average, you know, how many hours they spent in a particular week or a particular month meeting with a potential donor or meeting with a current donor. And then you can just do some sort of allocation of their time.
A related question is, you were talking about filing returns in every state where the organization does fundraising. What if they do all of their out-of-state fundraising online and they go through a service like Network Good, which is registered in every state, and they're kind of a conduit through which the organization does their online fundraising, online contributions? Does the organization itself need to also file, or is it that because their Network for Good is serving as their front end for online fundraising that they're covered?
Okay, so the question is, if an organization is doing online fundraising and they're working through another organization like Network for Good, do they have to file in every state because checks are really coming in from every state, or do they not have to because they're working through a conduit like Network for Good? And I guess I would ask, how does the check come into them, right? So is Network for Good sending them a lump sum check for everything that was raised in the year, and Network for Good is in the same state as them, and so really Network for Good is their professional fundraiser, if you will, in that sense? Or are the checks actually coming into them, as in, you know, Bob Jones is basically sending me $30,000 online, and Bob Jones lives in Florida. You know, also, am I mailing Bob Jones the donor acknowledgement letter, or is Network for Good mailing him the donor acknowledgement letter? So the question then becomes, how are the funds coming into me? If the funds are coming in directly to me from bank accounts all over the country, then what I'm going to do is I'm going to take a step back and do two things. Number one, am I actively pursuing these states, right? I've set up an online website. Have I done any sort of target marketing in these particular states to actively pursue out-of-state contributions? That's number one. Number two, do I have concentrations coming in from particular states where I start to get nervous? And so clients always ask me, you know, look, I got 2 donations from Florida. Do I have to do anything about it? There are certain states that are more aggressive about tracking you down than other states, right? So if it's one of the particularly aggressive states, I might go ahead and start filing if I saw I had a particular concentration from that state. If it's one of the more lax states, then you know, you kind of get legal advice and see where you want to go from there. Because then the other thing is, once you start filing in that state, they're going to keep looking for a return from you, right? Because you've now said, oh, I'm going to give you $200 every year. Well, they want their $200. They're going to keep looking for it. So once you put yourself on their radar, they're going to start looking for that return every year, and you may not be getting donations from people in that state every single year, okay? So again, you know, this is the type of thing where you probably want to get some sort of counsel. You want to take a look at your concentrations. You want to see whether it was a passive activity or whether you were actively seeking donations in those states. Do you have someone making phone calls to people in other states? Are you sending out letters all over the country, that type of stuff? Okay. Yeah, you know, it's a tough call, and I have to say the internet has made it even more confusing. So it's somewhat of a gray area. Uh-huh.
Is there like a specific written guideline for someone is considered an excess, sorry, I meant to say excess contributor?
Mm-hmm.
Is someone considered that if they give over a certain amount or a certain percentage?
Right. So the percentage is it's 2% of your total revenues over the course of 5 years. So it is a very specific calculation, although it's a little hard for me to give you set numbers because for every organization that's going to be a different number, right? But it is a set criteria in terms of you're going to come up with what the benchmark is, right? Which is going to be based on your 5-year average, a 2% threshold. And then you're going to take a look at that person's donations over the course of the past 5 years. Okay, and you're going to take their sum donation over 5 years over the benchmark that you just established and determine whether or not they're in excess. Okay. Yep. Okay. I guess that's it. Thank you.